Hi, my name is Christian Waldegrave, Manager of Research at Teekay, and this is our conventional tanker market update for February 2014. Now, when we spoke last month, rates adjusted a 5-year high, especially in the Aframax and the Suezmax sectors, where we'd seen rates on some routes in excess of $100,000 per day. And as we said last month, that was really due to two factors, some fundamental factors and some seasonal. On the fundamental side, we've seen that very strong imports in China. In fact, Chinese crude imports were a record high, 6.6 million barrels per day in January. And that was drawing a lot of crude from the Atlantic basin to the Far East, which was a big sink for ton miles. But we also had some seasonal factors, some weather delays, particularly in the Mediterranean and the Black Sea, some quite lengthy delays going through the Turkish Straits, and also in the US Gulf where they had some fog. Those weather delays have now by and large cleared. And on the fundamental side as well, this time of year we usually start getting into a period of refinery maintenance, and that's what's now started to kick in February. We're seeing that some of the refiners in the States are going through some maintenance, and the next couple of months we'll see some European refiners as well going offline for maintenance, and then a little bit later in April and May it will move to Asia. So usually this time of year we get the weather starts to improve, then you get the refinery maintenance, and it's quite normal for rates to come down, and that's what we've seen. The Aframax and Suezmax rates, having been at these 5-year highs in January, are now back to where we might have seen them prior to Christmas, sort of the low to mid-teens level. And we think that will continue through the spring months and possibly into the summer. However, what the recent spike has shown is that perhaps the market is tightening a bit more than we thought. And I think what has improved over the last few months is the demand side of the equation. So we've seen in recent months that the forecasts for oil demand have been steadily being revised upwards. For example, if we look at the IEA, their forecast for 2014 oil demand has been going up over the last few months. So they're gradually increasing their outlook, and that's really on the back of a stronger global economy. And that's all going to translate into stronger tanker demand during 2014 than perhaps we thought a few months ago. The supply side of the equation hasn't really changed. The tanker fleet will only grow by about 1% this year, and most of that is in the VLCC and the MR segment. So again, in the mid-range sectors, Aframax and Suezmax, there's really not much fleet growth this year. In fact, the crude Aframax fleet will probably shrink this year as it did last year. And so you have this situation where the fleet isn't really growing, the demand side is looking a little bit better, and we think that that means the market will start to tighten through the course of the year, which doesn't mean that rates will steadily improve on a linear basis, but what it does mean, I think, is that we will get more of this kind of rate volatility like we've seen over the winter, and more periods where rates start to spike, and these rate spikes will be a bit higher each time and last a little bit longer. So I think that's kind of the pattern that we're going to see through the year, but especially into the second half, when the fleet growth really slows down, and as we get back into next autumn and winter, when we start getting some of the seasonal factors again. So I think it is an improving tanker market. I think we've probably turned the corner. I don't expect 2014 rates will average much higher than 2013, although if we get some more of the spikes like we've seen over the winter, then it could well be. But certainly moving towards the back end of this year and into 2015, I think we'll start to see this the beginning of a meaningful tanker market recovery. So that's our tanker market update for this month, and we'll talk to you again in March.